Welcome to Next in Tech, an S&P Global Market Intelligence podcast where the world of emerging tech lives. I'm your host, Eric Hanselman, Chief Analyst for the 451 research arm of S&P Global Market Intelligence. And today we will be discussing blockchain and its various ramifications with research analyst Alex Johnston. Alex, welcome to the podcast.
Thanks very much for having me, Eric.
Well, thanks for being here. And we're continuing a conversation that's touched on a bunch of different aspects of things that are founded in blockchain. We were talking about cryptocurrencies. Charles Jansen was just on talking about decentralized finance or DeFi. One of the things I want to start out with is I think a lot of times, a lot of these things all get lumped together and get identified as all one big thing. But of course, as we've been teasing out, there are a lot of different aspects. And blockchain is really much more foundational. But I think it'd be useful to really start, before we get moving into some of the specifics and talking about some of the research, getting into really where blockchain is, what it's all about, what are the aspects of blockchain that our listeners should really be thinking about.
Sure. Thanks, Eric. So you've touched upon a couple of topics already. You mentioned sort of DeFi and cryptocurrency. But I suppose the best way of seeing it is building upon this blockchain layer. And really in trying to explain the value of blockchain, perhaps less so how it works, I think the umbrella terminology used to group the sort of technologies that blockchains are part of, this concept of distributed ledger technology, is probably the most helpful way of thinking of the value proposition. You've effectively got a technology which really supports, I suppose you'd consider it a shared oversight of data between multiple parties. But I think where it kind of differentiates is a perception of being tamper-proof or secure. There's a high degree of confidence in the data these multiple parties have access to. And that sort of tamper-proof nature is really where a lot of these technology vendors really see themselves as differentiating. It's this concept that as one individual within a large peer-to-peer distributed network, it's very difficult to manipulate or modify historic data. And that's really at its base level, I suppose, what blockchain's setting out to achieve.
So really a situation where there are a lot of eyes on the records themselves, that the system is that degree of immutable, and that large number of eyes gives you a certain level of security.
Yes, certainly. I think that's where companies see the value proposition. There's also this decentralized aspect, which, a way of seeing it can almost be philosophy, in that a lot of the organizations and evangelists involved in the space really see themselves a decentralizing force and a needed decentralizing force. And I think that's something to keep in mind when we think about enterprise applications. That in some cases, blockchain evangelists have a very broad societal-wide view of how this technology might be applied. And I think in some cases that's caused a sort of imbalance, I suppose, or enterprises who were piloting the technology perhaps didn't see it addressing a lot of the initial hope that the technology had, or a lot of the sort of narrative that these evangelists had sort of pushed. I think what's quite interesting is the market's now maturing. Scalability has made it more applicable for businesses, or improved scalability has made it more applicable for businesses. I think as the technology has matured, we are seeing the conversation changing somewhat. We're seeing greater success in the pilots that organizations are engaged in. We're seeing new use cases that enterprises are engaged in. We're seeing a lot more education or educated conversation surrounding a lot of this technology, which is quite exciting.
I mean, if you think about any technological revolution, I guess, if we dare to call it that. I mean, those in the vanguard are always really passionate. They've got some fairly idealized views of where it's going to go. And then we start to integrate the technology in ways that are practical and usable for organizations more broadly.
Yeah, I think something we're seeing, and again, I think later we'll probably cover this off when we talk about some of the data we found in our recent report. This concept of invisibility and integration is a really fascinating one in the blockchain space. Obviously, blockchain abstraction's been a sort of conversation point for a number of years now. This idea that actually, in part due to the lack of low-level programming skills associated with smart contract developments, things like Solidity or Rust and those sorts of programming programming languages has really meant that enterprises wanting to engage with the blockchain are having to do it at several levels of abstraction. And that's certainly where a lot of the development market is looking. But a lot of the companies we're talking to now have integrated blockchain to such a level within their technologies that you'd be kind of unaware that it had this distributed ledger underpinning in some cases. So things like data marketplaces, for example, are where we're seeing a lot of that kind of activity taking place.
As I keep saying, our listeners know that one of my favorite words about technology is abstraction. And we were talking about it around decentralized finance with Charles Jansen, the fact that you could actually put the DeFi pieces of a transaction within a payments process so that, in fact, you didn't ever have to worry about any of the detailed aspects. And you were talking about the coding requirements for smart contracts. The real value is when we start to get to those levels of abstraction that hide the complexities from those users who can really get value out of it. And that, you mentioned the data, that really is a lot of the interesting things I found in the study results we've got. So we've got a study that's just out about blockchain use. So what were the findings of the study, and what are the highlights?
So I think, obviously, straight off the bat, a lot of the focus, a lot of the conversation around the report surrounded the kind of adoption stats. Because what we found is, obviously, there's a lot of concern with the collapse of a lot of the cryptocurrencies from highs in late 2021 around adoption. But actually, enterprise adoption looks quite bullish. Around 21% of enterprises are currently making use of the technology. Although it is worth noting, obviously, there's quite a difference between different industries. So finance, unsurprisingly, the most mature, but areas like manufacturing and healthcare, there's a lot of investment in that space. But on top of that, 21% currently using the technology, around 19% are currently in a proof of concept or pilot stage. But what I think was quite interesting about the data is it's suggesting there's a bit of a stratification. So that sort of combined 40% is a very similar proportion to the number who are unaware of any plans to use within the next 3 years. You've kind of got the haves, I suppose, and a group we could almost call the will nots, which kind of, again, both those groups are sort of around 40%. There's very few organizations that sort of have it planned within the next 12 months or next 24 months.
Interesting. I wonder whether or not that's something that because we see this so often with a technology that gets heavily hyped, and there's a set of folks that are identifying that, it's too buzzy, it's too far out there aren't practical applications for it, it's just not for me, that kind of approach. It's interesting, though, that the study data show that it's sort of this barbell effect of, the haves and won't and will nots, as you said.
Well, I think actually diving into that concept of determining specific use cases, this idea of companies not really knowing how to apply blockchain is no longer so much the problem as the actual operational challenges or the implementation challenges. So around just under 30% of organizations were facing challenges around determining how to apply the technology. But actually, skills, for example, was a bigger barrier that enterprise was seeing. Concerns around privacy and security was a barrier organizations were seeing. Cost, operating cost, obviously goes hand in hand with a lot of the ESG concerns as well around, resource intensity and that sort of thing. So it was fascinating that companies that weren't implementing the technology weren't necessarily doing it because they couldn't see the value in it. Which would have been the case a couple of years ago. A lot of the conversation now seems to be tied into we're not in a position to make use of the technology. We don't have the skills. We don't have the infrastructure. And I think that's a really fascinating transition that the market seems to be taking.
Oh, interesting. So there is that significant segment who would potentially head there, but yet are being held back by skills gaps, availability of the technology in their sphere. Oh, interesting.
I think it's also worth viewing a lot of the sort of enterprise-focused markets still quite immature. So even some of the perhaps less enterprise-focused, but some of the blockchain networks are undergoing rapid development. So, but some of these networks have had issues with availability, for example. A lot of these issues have been related to scalability. So as many individuals know who might have tried to engage in Ethereum, for example, the cost of transacting those platforms are quite high. So I think there's still a lot of barriers that are preventing companies getting involved just from the technology side, no matter their own internal difficulties.
Well, one of the things we were talking about with decentralized finance conversations is, scaling there is, of course, a significant concern. And if the backend blockchain can't support the volume of transactions that are required to really make it work, that winds up being a significant issue. So are there aspects of the study that when we start looking at other pieces of the data that are helping to guide organizations or in terms of what they should be thinking about? I guess some of this is helping to build the depth of skills benches, those sorts of things. Are there sort of directions there that the study data was showing?
Yeah, so we've really touched upon abstraction, and I think I mentioned already this kind of focus on the application development side. A lot of the companies who are trying to build platforms to support companies setting up networks, setting up decentralized applications, are really building from what was initially just really hosting blockchain nodes to a far more sophisticated and holistic platform where they're thinking about how to sort of integrate on and off chain technologies, for example, how to integrate with sort of enterprise grade solutions, how to allow developers to use the IDEs of their choice, for example, REST APIs, those sorts of things. So I think that's maybe where the market's moving. I think rather than companies solving for the skills problem internally, although a lot of the vendors we've spoken to are putting a lot of focus on education, I think a lot of it might be solved for by blockchain almost becoming one potential architectural approach that organizations might be able to engage with through the tools they've already got available. So that's something that really stood out from the report.
So getting to platform capabilities that help to abstract away a lot of those complexities, as we were discussing. Interesting to see the levels of integration and where that goes, but if you can start to build it into the enterprise systems that are looking to whatever that record recording process happens to be, interesting ways to be able to do that and to build communities around it.
Something else which really stood out was this concept of a sort of multi-chain approach. So within blockchain networks, obviously, there's a huge number of different protocols and networks, some very famous ones, obviously Bitcoin, Ethereum. And when you think about programmable blockchains like Ethereum, you've also got things like Solana, Cardano, Algorand. On the private permission side, you've got things like Hyperledger. And all these different protocols really balance scalability, cost, decentralization, security, privacy. There's a wide array of different aspects to these protocols in terms of what they can be used for. And something which really stood out from the report is organizations are taking multi-chain approaches. So they're very interested in what's going on in public blockchain ecosystems, for example, like Ethereum. They want to be selling to consumers that are already an audience or a pre-made audience within these blockchain networks, for example. So that was a really fascinating finding, that organizations aren't restricting themselves to the Hyperledger fabrics, these permission private blockchains. Actually, they're thinking about the whole gamut, I suppose. They're thinking about all the different technologies available within the space. They're thinking very broadly about their adoption.
Oh, wow. So but that's something where we see, hybrid approaches in so many different aspects of tech. The various infrastructure elements. I mean, we've seen it in the growth of infrastructure capabilities, people starting to blend on and off-prem, being able to pull together what are the right resources for the right requirements. And it sounds like they're looking at doing the same kinds of things with blockchain to be able to take chains that meet particular requirements for different applications and blend them together. Fascinating. Are those things that they're platforms that'll help them leverage that kind of capability? Or is that something that organizations are looking to sort of do a mix and match more along the lines of having different capabilities available to them?
I think that's a direction of travel. So on the sort of Web3 native or startup side, a lot of the platforms designed to support application development are going towards blockchain neutrality, in that you can address a number of different protocols using their technology. That's less the case obviously in the space. There's these large hyperscalers. So IBM, for example, AWS, Oracle, those ecosystems or architectures are primarily built around a sort of single protocol or a limited number of protocols. Whereas on the Web3 native side, and not exclusively, there are companies like Telefonica, we spoke to recently, for example, who are looking at kind of blockchain neutrality, this idea that we should be supporting multiple protocols through our solution. It should be easy for developers to access these protocols.
Interesting.
And that's a really useful way to think about it, because when we talk about use cases for blockchain, obviously there's things like payments, but there's also things like supply chain tracking. If we talk about direct sales offering, loyalty and rewards programs, asset trading, data or document sharing, actively integrating it into a product. Those are very different series of needs. So to solve for that with just one blockchain network, you can sort of see why organizations are approaching this from a multi-chain perspective.
Well, one of the aspects of chains that I wanted to touch on, you'd actually mentioned before, the ESG and energy aspects. It's one of those things that I think we hear anecdotally a lot, which is concerns about energy requirements. But that's something that I think probably gets driven out of a lot of concerns about Bitcoin. And I think one of the things we've been talking about, unfortunately, there's a lot in this area that gets hit with a broad brush of concerns about crypto generally. I mean, we saw it in decentralized finance, that there were concerns that DeFi was in trouble because of crypto crashes, all these kinds of things. And I think that at least one of the things we hear are concerns about energy consumption in blockchain broadly because of the energy that's used for Bitcoin mining.
Yes, I think Bitcoin's a really good example of the challenge. So a lot of the early cryptocurrencies are built around a consensus mechanism, and this consensus mechanism is effectively a way of validating the data which is stored on the blockchain, securing the network, really. And these consensus mechanisms are very energy intensive, or at least initially with cryptocurrency. It was known as proof of work. And some of the coins are still linked to this sort of proof of work consensus mechanism. So you've got Elon Musk's favorite Dogecoin, for example, that famous and quite embarrassing meme. We've got obviously Bitcoin itself.
Come on, it's a cute meme.
But there is a transition away from those very energy intensive consensus mechanisms to significantly less energy intensive ones. So a nice illustration of that, I think I mentioned already, Ethereum, which is the largest sort of decentralized application ecosystem, and that's transitioning from the very energy intensive proof of work consensus mechanism towards a less energy intensive proof of stake. And a lot of the, I've already thrown out sort of Solana and Algorand and those sorts of organizations are looking towards significantly reduced ESG impacts. In fact, some of these Generation 3 or Ethereum killer blockchains, as they advertise themselves, looking to sort of supplant Ethereum's position in the public blockchain ecosystem, is really putting a lot of attention on this sort of ESG conversation, how actually their consensus mechanisms, their underlying architecture is significantly less energy intensive. In fact, some of these companies are advertising themselves as actually being sort of carbon negative through offsetting, which is a notable trend.
Oh, wow. Well, again, I could imagine, given the level of focus that was placed upon energy consumption, the ability to not only address it, but then go beyond addressing it and actually get to carbon negative would be, again, one of those very top of mind things that's going to help to hopefully drive adoption and get rid of some of the primary concerns around the technology itself. Well, what should organizations be considering around blockchain? As they're looking for the year ahead, it sounds like the study results, at least, are showing that there's a strong constituency that's moving along with this. What should the broader market be thinking about in terms of putting blockchain to work? Talked about the haves and the will-nots. Are there will-nots that should be considering that? Or is this something where use cases are maturing? What should they be thinking about?
I think the most sensible thing for organizations to keep in mind is to really narrow the focus on what blockchain's value proposition is, really. So viewing it at its base, the most fundamental level, this idea of multi-party visibility of data. And I think that circumstance that would be particularly useful is when data is at risk of being manipulated or modified, or circumstances in which it's not clear who the owner of that data would be. If there's 8 or 9 organizations all engaged in initiative, why should one company's vision be the single source of truth? Also in circumstances in which there's third-party need to verify or validate data, for example, and that's significantly increasing the sort of length of time it would take to run through a process. And they're all areas where I think blockchain is particularly valuable. So viewing it at that base level is particularly important when thinking about where it would be valuable to apply this technology. I think something that we were talking about before this podcast started recording, Eric, was the challenge of a kind of Wild West space in blockchain, kind of poor regulation, for example.
It's one of those things that I think comes up quite a bit, and it is one of those sort of broader concerns that thought that this is a technology that may be hard to master, that in fact the risks may not be fully understood because it's relatively early on. And, again, that lack of regulatory impact that sort of bleeds over from the crypto world is one of those things that, enhances people's concerns about risk. But yeah.
Yes, certainly. I think what really stands out, just touching upon the consumer space, is often when blockchains are conceived of or evangelists are talking about blockchain, there's a perception of how this sort of on-chain economy ends up representing and intersecting with the off-chain one. That physical assets or access to physical assets could be provided by tokenized assets and those sorts of things. But really, the challenge that blockchain faces is hyper-financialized. The point that if I was an organization, I'd be very reluctant to make a very valuable service available through sort of access to a token, for example, because that token can easily be sold on to another pseudonymous identity. I think hopefully as technology matures, it'll move away from these sort of low value speculative assets that are held entirely for speculative uses, and increasingly the sort of on and off chain integration improves. The companies do start accepting cryptocurrency payments, for example, or that companies might even start to think about how virtualizing physical assets and placing them on chain, for example, might be a useful way to store that data. I actually think the cryptocurrency crash might be quite beneficial to the enterprise market, perhaps less so B2C applications or selling into those communities, but in terms of maturing the technology, moving it away from this kind of speculative asset appreciation effectively, which is still how the media represents it. Indeed, how I think a lot of the people engaging with the technology are using it for, really.
Interesting. So in that shift, is that something where enterprises should be considering working with partners around it, direct engagement? I guess, what are first steps to sort of get toes in the water?
So what we've discovered is a lot of blockchain initiatives are consulting-led. So organizations will have their first interaction in terms of, building out the underlying infrastructure and architecture, understanding how it fits into digital roadmaps through consulting activities. Indeed, as a result of that, often organizations will leave with a sort of highly customized blockchain network, often private permissioned one, where individuals are sort of picking hand-picked entities to join them as part of this network. Over time, we see that kind of shifting. So veterans tend to start to invest up stack. So they start to explore how, rather than rely on consultants to build out these networks for us, we can start to use our own application tooling. We can start to build our own decentralized applications, or even purchase or gain access to pre-existing blockchain networks. And in some cases, organizations are starting to think, actually, there's a lot of exciting innovation going on within the blockchain, public blockchain ecosystem. Perhaps we can leverage that by looking at ecosystems that enterprises haven't traditionally been associated with. So I've thrown out some of those names already around Ethereum or Solana, for example. But to access those networks, organizations are often looking at partnerships with sort of scalability solutions in the case of Ethereum. So companies like Polygon, for example, which allow organizations to interface with Ethereum without having to worry about things like the slow throughput or the costs of doing so.
Again, useful abstractions that are making the technology more available and more practical. This has been fascinating, Alex, and especially after a lot of the top-level abstractions we've been talking with, to really look at some of the foundations of where blockchain really is, and some of the data. I will point our listeners to the Voice of the Enterprise data around blockchain that's just recently out. And thank you very much for being on the podcast.
Great. Thank you very much, Eric.
And that is it for this episode of Next in Tech. Thanks to our audience for staying with us. And thanks to our production team, including Carolyn Wright, Katerina Yakoviello, Ethan Simon, and our intern, Michael Asaolu, on the marketing and events teams, and our studio lead, Kyle Canilosi. I hope you'll join us for our next episode, where we're going to be digging into aspects of cloud operations, cloud pricing, some of the pieces that are really some of the upside of where cloud is today, with Melanie Posey, who's a returning guest for us. I hope you'll join us then, because there is always something next in tech.